Great. Thank you so much for that nice introduction, Maggie. And I see we have a really great turnout today. So let's go ahead and get started with our presentation. And I'm so excited to see so many of you here on the call. And if you're here, I'm assuming that you're already contributing to your 401k, which is fantastic. That's the first step. You're well on your way. The next step is, how the heck do you invest the funds that you're contributing every single paycheck into your 401k? And that's a little bit less straightforward. So that's what I'm going to help you out with today. And the first half of the presentation, we're going to spend some time digging into what your asset allocation should be. And let's back up a bit. What even is an asset allocation? So we'll spend some time talking about that, digging in there. And then the second half is going to be getting acquainted with your 401k, and specifically, how do you understand what funds are available to you, and how do you choose the exact funds to invest in? So as a high-level note before we get started, digging into the meat of this presentation, we always tell our clients to focus on what you can control when we're talking about investments. What's under your control? Well, how much you're spending versus how much you're saving, how much you're putting into your 401k. And then the next two are especially important. They're what we're really going to spend our time talking about in this presentation: your allocation and the fees you're paying for the funds in your portfolio. Some items that are somewhat under your control, what you're earning through your job, how long you're going to work before you retire, how long you'll live and need those funds, you know, how healthy you are, that sort of thing, somewhat under your control. What's not under your control on the right-hand side of the screen: market performance, what the market does on a daily basis, annual basis, that's really not under your control. And government policy regarding taxes, savings, benefits, again, not under your control. Now, unfortunately, what we hear about on a daily basis in the financial media tends to be those items that are not under your control. So if the TV and the media is starting to stress you out, honestly, you can go ahead and take a step back from that. So let's just focus on what's under our control. So starting with the first topic, what is an asset allocation? What the heck are people talking about when they're referring to asset allocation? And this is a really important topic to make sure that you understand. You can think of your portfolio similarly to a shopping cart, but instead of your milk and your bread and your fruit, you're going to have your stocks, your bonds, and maybe a little bit of cash. I'm throwing cash in there because it technically is an asset class, but really we don't want to see any cash in your 401k. I'll say that right up front. So when someone asks you, what is your asset allocation? A correct answer could be 60% stocks, 40% bonds. That's a perfectly fine answer to that question. But it gets even more detailed than that, and you can go the next level down. So if your allocation is 60% stocks, 40% bonds, the next level would be, well, what percent do you have in US stocks versus what percent do you have in international stocks? And then we can take it even one step further, and of the US stocks in your portfolio, how much do you have allocated to large companies? How much do you have allocated to small companies? And on the international side, non-US stocks, you typically hear about developed countries such as Australia, countries in Europe, Canada, and you hear about emerging market countries like China, Brazil, India is a big one, South Africa. You can also break down assets in the bond asset class to high yield bonds, treasuries, et cetera, et cetera. You can get really complicated with this stuff, but we're trying to uncomplicate things as much as possible during this presentation to get you moving in the right direction and get you investing in your 401k. So we can just stick with allocation in terms of stocks and bonds, and also important, how much in US stocks, how much in international stocks, okay? So why do you need to diversify? Why can't you simply put all of your money into a US stock fund? Now, this is an overwhelming slide, but before I lose you, stick with me here, I gotcha. We'll go through it really, really slowly. Let me turn on my little laser pointer here. So I hope you can see this little red dot. So this is a graph of all the asset classes, right? And each column here is a different year. You can see each color in this column. So this is the year 2004. Each different color block in this column is a different asset class. And they're ordered by which asset class performed the best that year. So you can see REITs, these are real estate trusts, they returned 31.6% in 2004. So that was the best performing asset class in 2004. And then they go all the way down to the worst performing asset class in 2004. And you can see that cash, 1.2%, not much of a surprise there. That was the worst performing asset class. Now, you'll also notice that right about in the middle, you have this nice gray square here. This is an asset allocation. This is, let's say, your portfolio, 60% stocks, 40% bonds. So this represents a combination of every single one of these asset classes in this column. Now, notice a few things here. One, your asset allocation is not going to be the best performing asset class in the year. Why? Because it's holding REITs, yes, so it did take advantage of some of this growth that real estate trusts saw in 2004, but you're also holding some cash, hopefully not a lot, but also holding some fixed income. Fixed income is just a fancy word for bonds. So you're taking advantage of the highest growth classes, but you're also being exposed to some of the asset classes that didn't perform so well there. So that's one thing to notice here. Something else to notice. Look at the year 2008. Does anyone happen to remember what happened in 2008? Wasn't a great year for the market, right? So look at your asset allocation here. Still 60% stocks, 40% bonds. Actually, compared to other asset classes, you performed pretty well. You were the third best. You were the third best performer of the year. So congratulations. But take a look and see what the return of your portfolio was. About negative 25%. Your portfolio lost 25%. And that's the second thing to keep in mind here. It's just because you have a well-balanced portfolio that contains every asset class, it doesn't mean that you're never going to see a year where you see losses in your portfolio. And that's simply the nature of how the market works. You're going to hold a basket of all of the asset classes in the market, but there are some years when pretty much the entire market is down. You can see fixed income, so these are bonds. They return about 5% that year, but you know, everything else did pretty poorly. So on average, every 1 out of 4 years is a down year in the market overall. So that's on average. You can expect that, but that means that every 3 out of 4 years is positive on average. So that's why you want to stick with your portfolio for the long term. You can see that the next year, 2009, your portfolio didn't do that well compared to other asset classes, right? You're only the 4th best performing asset class or worst performing asset class for the year, but your portfolio returned 25%. That's a pretty good return. And if we follow this out year over year, we can see that over this time period of 14 years, your asset allocation return on average year over year, 6.2%. That's a solid return. That's what we're trying to aim for here. And this is just to illustrate your portfolio over time, sticking with it. So now that we know that we have to be invested in a nice balanced portfolio over time that holds all of the various asset classes, how do you start to think about how conservative you should be, which is to say how many bonds you should have in your portfolio versus how aggressive you should be, how many stocks you should have in your portfolio. Now this is another chart. Stick with me here. It can be a little overwhelming. There's a lot of information here, but we've got 87 years worth of data from 1926 to 2013. And on the left-hand side here, you can see if you have a portfolio of 100% bonds, only bonds in your portfolio, this is the return over that 87 years. And you can see the top line here, 32.6%, was the best year's return for this portfolio. So in one single year, between 1926 and 2013, your portfolio of 100% bonds returned 32.6%. Now, the worst year down here, you can see it actually gave you a loss of minus 8.1% sometime during that time period. That was the worst year for this 100% bond portfolio. Now, averaged out over the 87 years, you can see that this portfolio returned 5.5%. Let's mosey on over to the right here, and we're starting to add more and more stocks into the portfolio. So here, right in the middle, we have a 50% bond, 50% stock portfolio. How did this portfolio perform over that same 87-year time period? Well, you can see that the best performing year was actually not that much better than what you experienced with bonds here. So the best performing year was 32.3%. The worst performing year was a loss of 22.5%, so significantly worse than what we saw in the 100% bond portfolio. But the average over that time period was 8.3% year-over-year return. So that is a significantly better return than what we saw with the bond portfolio. And if we continue to a portfolio of 100% stocks all the way here on the right, you can see the best year that this portfolio experience was over 54%. That's a phenomenal return. But let's take a look at the worst year, loss of 43% in this portfolio. That's a pretty tough bite. And then on average, about 10.2%. Why is this graph important? Why are we walking through this? What's important to pay attention to here is the bottom number here. Because this is the number that you could experience in your portfolio in any single year. And what you want to ask yourself is, what number is going to make me want to move to cash, essentially? What number is going to really freak me out and abandon my allocation and want to just go 100% bonds or just completely, entirely conservative? So let's say you're thinking about a portfolio here. Let's say it's about 60% stocks, 40% bonds, somewhere in this range. I'll just call it this column right here. And take a look at this loss of 30%, almost 31%. If you were to see this in your portfolio, in your 401k, how would you feel about that? How would that 1 year loss make you feel? If you think, well, I know the market goes up, I know the market goes down, this 31% loss, really not a big deal, I'll earn it back. Well then, great. This might be the perfect portfolio for you. You may even want to look at maybe the next step up. What about 35%? Do you have the time frame to be a little bit more aggressive? Now, if you see this 31% loss and that makes you instantly want to sell everything in your 401k and go to the quote-unquote safety of cash, this portfolio might be a little too aggressive for you. And you want to look at scaling back a bit, being more conservative. So let's look at what the next step down might be. Maybe a 55% stock portfolio. And let's take a look at this loss of about 26%. Does that give you the same gut reaction? Is that too big of a loss? If so, maybe we want to scale back a little bit more. Now, interestingly enough, women tend to be much better long-term investors than men. And it's because they tend to stick with an allocation for a long period of time. We are great as women at, give us a plan and we will stick to it. But we do tend to be less aggressive, especially less aggressive than we should be. So something to keep in mind as you're considering these losses. They may look very big. Remember, it's just a 1 year period. And so balance that with the need to also see your money grow over time. And the whole reason for, wanting to stick to a portfolio that is the right amount of aggressive but not too aggressive. I love this diagram here. Taking your portfolio more conservative after a decline in the market It's very much like taking parachute training after you've jumped out of the plane. It's a little late. It's a little late. You're locking in those losses, and then you're not going to have the stocks in your portfolio to recover over time. Okay, so that was a good primer on how to think about your asset allocation. But really, how should I invest? That may be a question you're asking yourself right now. And you have a couple of options. There are some great tools right now available to you. And the first option is to use an asset allocation quiz or calculator. You can easily Google asset allocation quiz or asset allocation calculator, and you'll have a ton of options pop up for you. I screenshotted a couple of them. One is from CNN Money. It's really, really simple. It asks you just a few questions. When do you need the money? How much risk can you handle? How flexible are you? And then how do you think about market sell-offs or market downturns? You click Get Results, and here it pops up your nice, lovely allocation where it thinks that you should be investing. So this is one way to get a feel for what your allocation might look like. There's also a quiz through Vanguard. This one's a bit more intensive, more nuanced. It tries to get more to the root of how you think about risk in your portfolio. There are 11 questions, and they tend to be a little bit more detailed. So this is another option that you can use, and you can see what they might recommend. And you'll see at the bottom of the screen for both the last screen and for this Vanguard quiz, we included the questionnaire, the link. So these slides will be distributed after the presentation, and you'll have them. You can go to these links if you want to do that. The second option you have to get a feel for what allocation might be appropriate for you could be to use target date funds. Target date funds are relatively new on the investment scene. I'm talking, they've gained in popularity over the last about 15 years. Target date funds are sort of an all-in-one, one-stop shop. You can almost think about, if you go to the grocery store, let's stick with the shopping analogy. So if you were to go to the grocery store during Thanksgiving holidays and you go up to the deli counter and they have those signs for your all-in-one Thanksgiving dinner. All you have to do is pay $29.99 or whatever it is, and you get your turkey, you get your stuffing, you get your green beans, you get your sweet potatoes, etc. So you don't have to worry about picking out, the Butterball turkey or the other name brand turkey. You don't have to worry about getting green beans in a can versus going to the fresh produce section. It's really just all pre-packaged for you. You don't have to think about the details. That's very similar to a target date fund. It's going to contain a mixture already for you, preset, of bonds and stocks. You're going to have US stocks, non-US stocks, large company stocks, small company stocks, and it's all being managed by somebody in the background, making sure that you're in the right allocation for you. Now, how does this target date fund know that this is the right allocation for you? Well, you can always tell what a target date fund is because it will always, always have a year in the name. So you can see that this is the target date fund for 2035. So what does 2035 mean? That means that that's the year that you anticipate retiring. You anticipate retiring in 2035. So let's take a look. If we're in 2019, for somebody retiring in 2035, this is what the Vanguard Target Date Fund thinks that your allocation should look like. And you can see there's about 47% in US stocks, 31.5% in non-US stocks, and then you've got about 20% in bonds. So from a high level, you're in about 20% bonds, 80% stocks in this portfolio. The nice thing about target date funds is that notice how over time these colors are changing. And that's because over time, as you approach your retirement date, your fund becomes more and more conservative for you automatically. So if we're looking at bonds are the blue. You start out here, your bonds are not taking up a substantial amount of your portfolio yet, but as you get closer and closer and closer to retirement, they're going to start taking up a much larger percentage here of your portfolio. So retirement target date funds can be a really excellent option to either invest in, and we'll talk a little bit more about that in a few more slides, or simply to give you an idea of how you might want to be thinking about your own asset allocation. And you can very easily look up the target date fund for when you want to retire, whether that's sooner than 2035 or much later than 2035. The whole point here is there's no need to reinvent the wheel. You don't need to learn about investment portfolio theory here. Let's use the tools available to us to get a good enough asset allocation and go from there. We're all about making progress. So moving into the second part of the presentation, which is diving into your 401k, becoming acquainted with it, figuring out what options are available to you, and also figuring out which of those options are the right ones to invest in. Now, this is a screenshot of what your 401k may look like when you log in. There's a lot of variation here, a lot of variation. Yours could look nothing like this. It could be simply a list of funds. It can be overwhelming, and we have seen a lot of 401k plans, some better than others. So I want to start by simply saying that when you log into your 401k, start by becoming familiar with what is in front of you on the screen and orient yourself around what options there are. You'll find that all of the funds available are already categorized based on the different asset classes. They'll always be grouped based on asset class. So here you can see it's really quite clear in this plan. Short-term bonds, stable, and money markets. A note about stable and money market funds, that means cash. Don't invest in those. In your 401k, you can't touch that money until you're way down the line anyway. So unless you're actually in retirement and still have your 401k plan, there's no reason for you to be investing in cash. So you can sort of move past that asset class. So you'll see you have your intermediate and long-term bonds, aggressive bonds, also referred to as high yield bonds, large company stocks, another silly financial lingo, large cap. Cap simply means company. So don't let that confuse you. Large company stocks, small mid-company stocks, international non-US stocks, and then other. And here you'll see are all of your target date funds. They're not always called target date funds. Notice here it doesn't say anything about target date anywhere. Sometimes they're called balanced funds, but you can always tell that they're target date funds based on this year here. That's how you can tell. That's the giveaway. So here's another example. This is a Vanguard retirement plan, actually, and all of the funds were simply listed in one long line. I am a fan of Vanguard, but it was pretty confusing when I logged into this 401k and was trying to look at all of the funds at once. But again, you'll notice, just take a step back, they're all categorized for you. Here, the target date funds are called balanced funds, domestic stock funds instead of US stock funds, international stock funds. Also, a couple things to point out here. You'll see specialty stock funds. They do offer in this particular 401k plan a real estate investment trust. If you're looking at these specialty stock funds, they really should not be playing a large role in your portfolio. 5% or less is sort of the general recommendation here, but it looks like they are an option for this 401k plan. And you may notice in your 401k a self-directed brokerage account. Some 401k plans do offer this. This essentially means that a new account will be opened in your name. It's still a 401k plan, but you don't have to stick with these pre-packaged fund options. You can pretty much invest in anything you want. Now, unless you have really specific investment desires and you're really well versed in investing for yourself, I would recommend sticking with the options that you have available to you in the funds because it tends to add more structure to your investing. So let's dig in. So we're going to need some large company US stocks in our portfolio, I can tell you that. And we see we have 3 options in this category. Now, 401k plans, they're only required to offer you one fund in each category. So here you have 3 funds. Let's take a look to get to know them a little bit more. You'll notice that one is a large value, one is large core, and one is growth. Now, there are different types of US companies. There are companies like Google and Amazon. Those are categorized as US large cap growth companies because they tend to shovel all of their profits back into the company in an effort to grow as fast as they possibly can. So those are growth companies. A lot of tech companies fall into the growth umbrella. There are also value companies. Value companies might be like Procter & Gamble or Disney, for example. Value companies, you tend to buy them because you think they're undervalued. You think that they tend to be a little bit more boring. They pay their investors a dividend. You can think of a lot of blue chip stocks as value companies. And then core is a mixture of the two. When you're thinking about value versus core in your US large company stock holding, typically you want to even them out. So you can see actually even in this recommendation or in this example, we have about 7% in US large cap value, roughly even 8% in US large cap growth, and then the balance here in large company core, which is a combination of the two. For your own 401k, if you don't want to mess with looking into all of these funds and figuring it all out, choosing one fund is just fine. Choosing just the core fund, that's an absolutely okay choice. So let's dig in a little bit more. This is our Transamerica Large Value Opportunities investment. So that was our first option. This is a lot of information on this page. There's a ton of information. And how you can get to it is simply by clicking here on this hyperlink. So you can typically just click on the hyperlink of the funds in your portfolio and it'll pop up this data sheet. And there's going to be a ton of information on it. But stick with me, don't get overwhelmed. 90% of this information you're not going to need. You're not going to need. So let's look at what's important. First, orient yourself about what it is you're looking at. And we can see this classification, it's a large company stock. Okay, got it, large company stock, okay. You also want to look at the Morningstar rating. Now, a majority of funds are given a Morningstar rating. There are 5 stars possible. So 2 stars out of 5 stars, if this were a hotel, I don't know that I'd really want to stay there. Typically, we look for at least 3 stars. And that should be in general the minimum that you're keeping in mind. Something else that you want to take a look at is fund rank percentile. Now that's a kind of a complicated way of saying how did this fund perform compared to its peers? How did this fund do? And we can see over the various time horizons, so 3-year, 5-year, and 10-year, we see 90, 72, and 78. But just to add an extra twist here, unlike when you take a baby to the doctor and the doctor says, oh, great news, your baby is in the 99th percentile for length or height or whatever they call it, and that's a good thing. That means that they're taller than 99% of all the other babies. This works the opposite way. This is more like a race, and in a race of 100 athletes, this fund over the 3-year period came in 90th, over the 5-year period came in 72nd, and then the 10-year period came in 78th. So this fund's not looking so hot. Typically, we want to see a fund in the top 50. So in this case, 1 through 50, much like in a race, much better than 51 through 100. Okay, so we're starting to get to know a little bit more about this fund that we're looking at. We're starting to get a little bit more comfortable with it, but we're not ready to swipe right yet because we haven't found the most important information. And what is that? Remember back to that first slide, what is one of the things that we can control? And that is the fee that we are paying. So here, again, of course, it's not just listed as fee, it's called expense ratio. But here it is, that expense ratio for this fund, 0.97%. We want to see a fee of less than 1%, absolutely less than 1%. This, it's pretty high. It's pretty high. It's almost 1%. So this fund is not knocking my socks off, I gotta say. And if you can only find one piece of information about a fund, then you want to look at the fee. You want to find that expense ratio. It might be hard to find, but it will always be there. It will always be there. So keep digging until you find it. Something else to look at about each fund is the underlying portfolio analysis. What is this fund really composed of? And we can see, well, it's about 100% US stocks, what we would expect. Okay, no surprises there. Good, keep going. And then the last thing we want to check out, total number of stock holdings, 118. We want to see a diversified fund, especially if you're only choosing a few for your 401k. You want it to be as diversified as possible. So a minimum of 100 holdings, should be what you're looking at. Okay, so let's move on to the next fund. Let's see what this large core fund looks like in our portfolio. Is this a good option for us? And you can see that this data sheet looks a little bit different than what we were looking at before, but it's okay because the information we need is still available to us. It's still here. So first, again, orient ourselves around what it is we're looking at. This Morningstar category, it's a large blend. And by the way, if it doesn't say large international blend or just developed international, they're just referring to the US. We're very egocentric here. So if we don't specify it's a non-US fund, it's a US fund. So we're talking large blends. We're comparing it to the S&P 500. Number of holdings, 221, so that's great. It's above our 100 fund, our 100 stock minimum there. And let's take a look at the asset allocation. Yep, we're pretty much, it's got a hair in non-US stocks, but nothing huge. So we're going to just call it 100% US stocks for the purposes of our allocation. So we're good to go there. Now let's take a look at the total return performance. This is what I could find instead of the rank against its peers for this particular fund class. So that's why we're looking at the total return performance, and it compares it to the S&P 500. And what I noticed when I looked at this was that across the board, all of these time periods, you can see it's performing just a 1 or 2% less than the S&P 500. Now, that tells me one of two things. One, it has potentially a high fee, a high expense ratio, or two, maybe, it only has 221 holdings, but it's supposed to be a large blend that's carrying the whole S&P 500. Well, there are 504 or so stocks in the S&P 500. So it's not, maybe it just didn't pick the winners for the year. So that could explain the lack of performance. Or here, take a look. I did more diving and digging, and the expense ratio it's pretty high, 0.9%. That's pretty high, and that could explain why, at least part of why it's not performing as well. And this is a good illustration of why the fees that you're paying in funds are so important, because if your fund that you're investing in has a 1% fee, you have a 1% hurdle that you have to jump over simply to get any return. And you can see that over time, that can really have a big impact on your portfolio returns. Here, 2% over the 3-year time horizon, 1.5% over the 5-year time horizon, nearly 1% over 10 years. So a high fee is an extra high hurdle that you have to jump, and you shouldn't have to. So let's dig into some of our target date fund options here. And we'll just start by looking at the T. Rowe Price Retirement Fund 2050. And instead of clicking on this particular fund and having the data sheet open, there are some 401ks out there that, the fund name is not a hyperlink, and it's a little bit tougher to find the data sheet. And in fact, the Vanguard option I had open earlier was just like that. So what do you do in that case if it's not easy to find the data sheet? Well, the answer is pretty straightforward. Luckily, we have this tool called Google, and you can simply type in the name of the fund or the ticker symbol followed by Morningstar. It's really, really that easy. So here, this is my exact exactly what I searched for, T. Rowe Price 2050 Fund Morningstar, and you can see what it brought up. Now, the first option it brings up typically is an ad. You know that it's the right thing that you're looking for if it says Morningstar. If it's coming from Morningstar, you go ahead and click on it, and you know it's going to bring up the Morningstar snapshot report, and that's what we're looking for. So here we click on it, we see the T. Rowe Price Retirement 2050 Fund. What's the first thing that jumps out to you? It's like, wow, this has 5 stars. This is fantastic. So 5 stars, 5 out of 5, that's good. Expense ratio, 0.72. That's a little bit on the higher end, but target date funds do tend to be a little bit more expensive than your typical funds. And if we're going back to the last 2 funds we looked at, well, heck, this fund looks like a deal compared to those. So 0.72 is about average for a target date fund because they're doing all of the heavy lifting, choosing between the bonds, between the stocks, the whole allocation for you. Something else to look at, and this is called a load. And again, I wish they called it a load fee so that you knew what it was. A load is something that is luckily going out of fashion a bit, but we still see it from time to time, and it's a horrible, horrible, horrible thing. So there are some funds that have a load fee, and it can either be one of 3 different types. There can be a front load fee, and in that case, every single time you buy into that fund, you're going to be paying a commission to a broker simply for buying into the fund. And that's on top of the expense ratio, the normal underlying fee. And these load fees can be as high as 5.75%. So we're talking not insubstantial here. So you can have the upfront load. Some funds have a load fee that is continuous, and they'll charge you every single year an extra 1%, again, just commission to the broker. And then you have some load fees that are back-end load fees. And so when you sell the fund, that's when the broker gets his slice of the commission. In any case, you never want to invest in a load fund simply because there are tons of other options for funds out there. There's no need to be investing in load funds. So always make sure this load says none here. Okay, so in this case, when we Googled the fund and we brought up the Morningstar data sheet, I had to do some clicking on the tabs above. Sometimes you're going to have to do a little bit of digging to find the information you want, but the information we're going through today, know that this is really standard stuff that's on data sheets for funds. You should be able to find this information. So if you can't find it right away, be patient, keep digging. It's there. It just may be in a different window, a different tab. So here we can see the percentile rank, how this fund has performed against other funds in its asset class. And overall, each year, I mean, pretty good, looking pretty good. Remember, we want 1 to 50 in general. Now we can see in 2016, it was 62nd. That's not that bad. That's really not that bad in terms of if we're looking at overall, it averages out well below 50. So this is looking good. Don't get hung up on one single year. And if we click on the portfolio tab here, we can see really what is this fund investing in. And again, this is the 2050 retirement fund. We've got about 50%, 55% US stocks, 31% non-US stocks, about 11% bonds. So from a high level, this fund is pretty aggressive. We're talking 89% in stocks and 11% in bonds. If you plan on retiring in 2050, but you look at this fund and you think, 90% in stocks is a little bit more than I had bargained for. I don't think that I'm going to be able to stick with this portfolio if we see a year like 2008 again. Then you know what? That's fine. Maybe look at the next more conservative fund. And the next more conservative fund is going to be the retirement fund for, say, 2040 or 2045 or 2035. Essentially bring in that retirement date, and you'll see that the funds have more and more exposure to bonds. So it's perfectly fine to invest in a fund that doesn't exactly match up with your retirement date. Make sure that you are comfortable with the allocation within this target date fund. Okay, so back to the Vanguard 401k and what it offers. Here, again, it's all of the U.S. stock funds are labeled as domestic stock funds. And let's take a look at the Dodge and Cox stock fund here. So diving a little deeper into this fund, we can see for Morningstar, stars, that's good. No load fee, perfect. Relatively, low expenses, 0.5%. That's within our range. It's less than 1%, good. And let's take a look at the asset allocation to better understand what this fund is investing in. U.S. stocks, we see it's about 84%. So it's not, even though if we go back, we look and it's under the domestic stock fund header, it's not 100% in U.S. stocks. There's actually almost 13% in non-U.S. stocks. Now that's fine. This could still be a fund that you want to invest in. But know that if your intent is to invest in, let's say, 40% U.S. stocks, and so you allocate 40% of your 401k to this fund, that it's not a true 40%, because actually 12.6% of this fund is in non-U.S. stocks. Now that could be fine. You'll just have to do a little bit of math on your end, but it's something to keep in mind. It's why you should always check this asset allocation box just to make sure. We can take a look at the percent ranking category. How did this fund perform compared to its peers? And we can see overall pretty darn good, especially in the 10-year range, 3-year range, did really well. Something else interesting about this fund, you can see this Morningstar sustainability rating. This is relatively new, Morningstar offers it for 20,000 funds, so not a huge number of funds. You may not find it for everything, but if socially conscious investing is something that interests you, Morningstar has put together its own rating system to rate, how well does this fund invest in companies that show positive movement towards environmental, social, and governance, and that's sometimes referred to as ESG, environmental, social, and governance. How well do the companies within this fund operate when it comes to those three factors: environment, social factors, and then governance, how they run their company. So if this is something that's interesting to you, this particular Morningstar Snapshot report, this particular fund actually has a rating for sustainability, and something to keep an eye out for. Okay, so we've gone through a lot, and there's a lot more that we could continue to dive into. This is, you can really get into the weeds, but again, we're trying to keep this a little bit more high level, give you the information you absolutely need so that you can go into your 401k and confidently decide what your allocation is going to be from a high level and choose funds that fit into that allocation. So if you're feeling more overwhelmed at this point in the presentation than maybe you did in the beginning, because we've gone through so much information, two things here. One, you'll get the slides afterwards. You can go through. I've highlighted the most important pieces. But then two, I've listed in order of importance really what you should be focusing on. This will get you 90% of the way there. And one, start with your overall allocation. Take some of those allocation quizzes online, run through some of those questionnaires, look at target date funds for the year in which you want to retire, and think about what mixture of stocks and bonds you'll be comfortable with. So start at the stock versus bond level, and then dive in just a little bit deeper. And of the stock piece, how much do you want to allocate to US versus non-US? The second step, find at least one good fund option for each asset class in your allocation. So you're going to need a bond fund, you're going to need a US stock fund, you're going to need a non-US stock fund. And if you just find one good fund option that has low fee and absolutely no load, you can hit the ground running. That's good enough to get you started. And when in doubt, take a look at the target date funds if those are an option for you. Those, no need to reinvent the wheel. Those are a perfectly fine way to get started. And just make sure that it's a low fee, because some target date funds, in my husband's 401k, for example, some target date funds can be as high fee as 2%, and you absolutely want to stay away from those. And to put it all together, Google the fund ticker or the name if you can't easily find the data sheet, followed by the word Morningstar. It's that simple. You can bring up the Morningstar data sheet for that fund and take a look at, make sure to orient yourself around what you're looking at. Look at the fund classification. What asset class does this fund fall into? The expense ratio. This is the most important thing. How expensive is this fund? Should absolutely be less than 1%, and never ever invest in a load fund. And then other information you want to take a look at: Morningstar stars, minimum of 3 stars, the fund rank percentile, how the fund has performed compared to its peers. Remember, it should be in the top 50. 1 to 50 is better than 51 to 100. And you can also take a look at the number of stock holdings. So how diversified is this fund? And avoid funds with less than 100 holdings. And to sort of wrap it up, there are a couple extra, because I know we're running out of time here, but there are a couple other just general tips when you're thinking about your 401k. One of those, don't let cash sit around in your 401k. Unless you are in retirement and you're actively pulling from the cash in your 401k, there's simply no reason that you should ever let cash accumulate in your 401k. Then that includes quote unquote stable funds and money market funds. Both of those mean cash. Avoid. Take advantage of a couple really cool 401k features that have hit the scenes in the last 15 years or so. One of those is automatic rebalancing. Not all 401k plans have this option, but some do, where you can rebalance once or twice a year. Because even if you set up your allocation to invest 30% in Fund A and 40% in Fund B and 30% in a bond fund, over time, as the market fluctuates, you're going to get out of balance a little bit. So if you have automatic rebalancing, it will automatically, once, twice a year, rebalance your whole account to make sure that you're right within that allocation that you wanted. And you never have to think about it. It's automatic. And then the second is the annual incremental contribution increases. Some 401k plans allow you to increase your contributions each year by 1%, 2%, really however much you want. And if you set it for 1 or 2%, as you get your pay increase, you won't even notice the extra percent that's going to your 401k. Before you know it, you will be maxing out your 401k and you'll have never felt it. So that's a really fantastic tool that's available in some 401ks. And finally, just to reiterate the most important, avoid funds with high fees. Definitely avoid any funds with anything over 1% in fees. So Maggie, that's all I have in prepared presentation material today, but I know I've seen a few questions come in on my end, so I'll let you take it from here.
Okay, great. Thank you, Natalie. That was wonderful. Thank you so much for taking the time to clearly explain everything. So as a reminder, if you have a question now, you can use the chat box or you can email info@savvyladies.org. And I see we had some questions come in as well. So the first one we have for you is asking, with the info that you shared today, do you think that someone can pick their portfolio on their own, or do you recommend using a professional? And if you use a professional, what are the average fees for that?
Oh, great question. And the information that we shared today, the intent is to empower and educate our listeners to take a look at what options they have available in their 401k plans. And because this is something that you can start to do on your own. That being said, depending on what life stage you're at, you can really benefit from working with a certified financial planner. Absolutely. And what's important to keep in mind here is there are a lot of different quote unquote advisors out there. You have some advisors that operate more like brokers, and they will simply manage your investments. I would recommend in working with an actual CFP professional, someone with the CFP designation. And the reason is because a CFP has a fiduciary obligation to do what is in your best interest. And that's different from simply a broker. So a broker is someone who can recommend something that's suitable for you, such as, you know, if you just need a US stock fund, then a broker can give you any US stock fund, including one that maybe has a higher commission to that broker. So a CFP, for example, to compare, has to give you the best fund for you. So a CFP will help you to pick out the lowest fee fund for your individual particular situation. So highly recommend working with a certified financial planner, and fees can range based on the type of work that they're doing for you. They work either on an hourly basis, and then they'll charge you hourly, maybe just to get you up and running. So you can sit down with a financial advisor for a couple of hours and work to get your 401k set up, and you'll be off and running. Or you can work with someone more long-term, and they'll actually manage your portfolio for you. They'll do financial planning, and they'll charge based on an assets under management. Anywhere from 1 to 1.5% is what that fee typically ranges.
Okay, great. Thank you. Moving on to the next question is asking, is a 401k totally different from a Roth IRA, or do these principles also apply?
A great question. These principles can mostly apply to your Roth IRA. I'm a huge fan of Roth IRAs. And the difference is that in your Roth IRA, you're opening an account that is not connected to your employer. Now, I'm talking Roth IRA. There's also a Roth 401k. And a Roth 401k, that's still under the 401k umbrella. But a Roth IRA that you go and set up, you can set one up really anywhere, Fidelity, Vanguard, Charles Schwab, etc. It's not going to have these pre-packaged options for you. So you're going to need to do a little bit more research on your end and try to find the best funds for you for that US stock piece, for that developed international piece, etc. But these basic rules absolutely apply.
Okay, thank you. And I think this is our last question here, asking, if you're nearing retirement and the market takes a downturn, what can you do? So Natalie, maybe could you just talk a little bit about this? I know this is definitely a real fear for everyone, that as they're getting closer to retirement and then the market tanks. So can you just talk a little bit about that?
Yes, and it's a fear that we hear from our clients frequently. But the important thing to know, and this is sort of a counterintuitive way of thinking about it, when you think about your retirement, many people think about it as the finish line. I'm just going to work until I reach retirement, and then I'll have crossed that finish line. And so when they think of that their portfolio, they too think of their portfolio as needing to reach some sort of invisible finish line at the start of their retirement, when in reality, your the beginning of your retirement is actually the start line for the next 30 years of your life. So you need your portfolio to continue to work for you, not only just up to retirement, but through and beyond retirement as well. So if you're approaching retirement, and let's say you've been working several years, you've been very aggressive, and you're thinking about scaling back in how aggressive you are and how many stocks you have in your portfolio, you might be surprised at how many stocks, what percentage of stocks you still need, because you still have 30+ year time horizon beyond retirement to be thinking about. You need your portfolio working for you.
Okay, great. Well, I want to thank you again, Natalie, for an excellent presentation. Thank you so much for explaining something that can be kind of confusing and scary to some of us, and so thanks for clearly explaining it. I want to thank everyone for joining us today, and as Natalie mentioned, we'll be sending out the links to those quizzes, so you'll have a chance to take those. And thank you again so much.
Thank you so much, Maggie, and thank you to everyone who took time out of their day today to join us.
Thank you. Bye-bye.